would be concluded in 1960. This hope materialized. The history of an investment of this magnitude may be of interest to you. Sanborn Map Company is engaged in the publication and continuous revision of extremely detailed maps of all cities of the United States. For example, the volumes mapping Omaha would weigh perhaps 50 pounds and provide minute details on each structure. The map would be revised by the paste-over method showing new construction, changed occupancy, new fire protection facilities, changed structural materials, etc. These revisions would be done approximately annually, and a new map would be published every 20 or 30 years when further paste-overs became impractical. The cost of keeping the map revised to an Omaha customer would run around $100 per year. This detailed information showing diameter of water mains underlying streets, location of fire hydrants, composition of roof, etc., was primarily of use to fire insurance companies. Their underwriting departments, located in a central office, could evaluate business by agents nationally. The theory was that a picture was worth 1,000 words, and such evaluation would decide whether the risk was properly rated, the degree of conflagration exposure in an area, advisable reinsurance procedure, etc. The bulk of Sanborn's business was done with about 30 insurance companies, although maps were also sold to customers outside the insurance industry, such as public utilities, mortgage companies, and taxing authorities. For 75 years, the business operated in a more or less monopolistic manner, with profits realized in every year accompanied by almost complete immunity to recession and lack of need for any sales effort. In the earlier years of the business, the insurance industry became fearful that Sanborn's profits would become too great and placed a number of prominent insurance men on Sanborn's board of directors to act in a watchdog capacity. In the early 1950s, a competitive method of underwriting known as carding made inroads on Sanborn's business, and after-tax profits of the map business fell from an average annual level of over $500,000 in the late 1930s to under $100,000 in 1958 and 1959. Considering the upward bias in the economy during this period, this amounted to an almost complete elimination of what had been sizable, stable earning power. However, during the early 1930s, Sanborn had begun to accumulate an investment portfolio. There were no capital requirements to the business so that any retained earnings could be devoted to this project. Over a period of time, about $2.5 million was invested, roughly half in bonds and half in stocks. Thus, in the last decade particularly, the investment portfolio blossomed while the operating map business wilted. Let me give you some idea of the extreme divergence of these two factors. In 1938, when the Dow Jones Industrial Average was in the 100 to 120 range, Sanborn sold at $110 per share. In 1958, with the average in the 550 area, Sanborn sold at $45 per share. Yet during that same period, the value of the Sanborn investment portfolio increased from about $20 per share to $65 per share. This means, in effect, that the buyer of Sanborn stock in 1938 was placing a positive valuation of $90 per share on the map business, $110 less the $20 value of the investments unrelated to the map business, in a year of depressed business and stock market conditions. In the tremendously more vigorous climate of 1958, the same map business was evaluated at a minus $20, with the buyer of the stock unwilling to pay more than 70 cents on the dollar for the investment portfolio, with the map business thrown in for nothing. How could this come about? Sanborn in 1958, as well as 1938, possessed a wealth of information of substantial value to the insurance industry. To reproduce the detailed information they had gathered over the years would have cost tens of millions of dollars. Despite carding, over $500 million of fire premiums were underwritten by mapping companies. However, the means of selling and packaging Sanborn's product, information had remained unchanged throughout the year, and finally this inertia was reflected in the earnings. The very fact that the investment portfolio had done so well served to minimize, in the eyes of most directors, the need for rejuvenation of the map business. Sanborn had a sales volume of about $2 million per year and owned about $7 million worth of marketable securities. The income from the investment portfolio was substantial. The business had no possible financial worries. The insurance companies were satisfied with the price paid for maps, and the stockholders still received dividends. However, these dividends were cut 5 times in 8 years, although I could never find any record of suggestions pertaining to cutting salaries or directors and committee fees. Prior to my entry on the board, of the 14 directors, 9 were prominent men from the insurance industry, who combined held 46 shares of stock out of 105,000 shares outstanding. Despite their top positions with very large companies, which would suggest the financial wherewithal to make at least a modest commitment, the largest holding in this group was 10 shares. In several cases, the insurance companies these men ran owned small blocks of stock, but these were token investments in relation to the portfolios in which they were held. For the past decade, the insurance companies had been only sellers in any transactions involving Sanborn stock. The 10th director was the company attorney, who held 10 shares. The 11th was a banker with 10 shares who recognized the problems of the company, actively pointed them out, and later added to his holdings. The next 2 directors were the top officers of Sanborn, who owned about 300 shares combined. The officers were capable, aware of the problems of the business, but kept in a subservient role by the board of directors. The final member of our cast was a son of a deceased president of Sanborn. The widow owned about 15,000 shares of stock. In late 1958, the son, unhappy with the trend of the business, demanded the top position in the company, was turned down, and submitted his resignation, which was accepted. Shortly thereafter, we made a bid to his mother for her block of stock, which was accepted. At the time, there were 2 other large holdings, one of about 10,000 shares, dispersed among customers of a brokerage firm, and one of about 8,000. These people were quite unhappy with the situation and desired a separation of the investment portfolio from the map business, as did we. Subsequently, our holdings, including associates, were increased through open market purchases to about 24,000 shares, and the total represented by the 3 groups increased to 46,000 shares. We hoped to separate the 2 businesses, realize the fair value of the investment portfolio, and work to reestablish the earning power of the map business. There appeared to be a real opportunity to multiply map profits through utilization of Sanborn's wealth of raw material, in conjunction with electronic means of converting this data to the most usable form for the customer. There was considerable opposition on the board to change of any type, particularly when initiated by an outsider, although management was in complete accord with our plan, and a similar plan had been recommended by Booz, Allen, and Hamilton, management experts. To avoid a proxy fight, which very probably would not have been forthcoming and which we would have been certain of winning, and to avoid time delay with a large portion of Sanborn's money tied up in blue-chip stocks, which I didn't care for at current prices, a plan was evolved taking out all stockholders at fair value who wanted out. The SEC ruled favorably on the fairness of the plan. About 72% of the Sanborn stock, involving 50% of the 1,600 stockholders, was exchanged for portfolio securities at fair value. The map business was left with over $1.25 million in government and municipal bonds as a reserve fund, and a potential corporate capital gains tax of over $1 million was eliminated. The remaining stockholders were left with a slightly improved asset value, substantially higher earnings per share, and an increased dividend rate. Necessarily, the above little melodrama is a very abbreviated description of this investment operation. However, it does point up the necessity for secrecy regarding our portfolio operations, as well as the futility of measuring our results over a short span of time, such as a year. Such control situations may occur very infrequently. Our bread and butter business is buying undervalued securities and selling when the undervaluation is corrected, along with investment in special situations where the profit is dependent on corporate rather than market action. To the extent that partnership funds continue to grow, it is possible that more opportunities will be available in control situations. Lessons from controls. After Sanborn, Buffett continued executing control transactions throughout the rest of the partnership era and discussed two others, Dempster Mill and Berkshire Hathaway, in detail. Each case offers key insights for today's investor. Each had its own way of illuminating the linkage between a security's value and a business's value in a way that helps parse out true economic value from the accounting figures. You may have heard others claim the term value investing is redundant because all investing is value-based. No one sets out to intentionally overpay for stocks. This is somewhat similar to the idea of investing in a business, as opposed to being in that business. Stocks are simply a conduit through which we own a company's assets. When we invest our capital into a company's stock, we enter into its particular business. In 1960, 1/3 of the partnership was in Sanborn's stock, meaning 1/3 of the partnership was in the business of selling insurance maps and managing a securities portfolio. In his discussions on controls, Buffett is teaching us to not think about investing in a stock, but instead to think about being in a business. Whether you are running a business or evaluating one, a singular question remains paramount. What is its value? Both in terms of the assets involved and the earnings produced. Then, how can it be maximized? The skill in answering the questions determines the success of investors and business managers alike. Buffett's lessons, taught through the lens of his controls commentary, shine a bright light on the subject. Graham was first to say it, and Buffett often repeats it. Investment is most intelligent when it is most businesslike, and business is most intelligent when it's most investment-like. Let's look at this wisdom in action, in the birth of a control. You'll recall from our look at the generals that these were often stocks bought at a discount to their private market value, with the idea that they would be held until they appreciated, at such a time that they would then be sold. As he said, "We do not go into these generals with the idea of getting the last nickel, but are usually quite content selling out at some intermediate level between our purchase price and what we regard as fair value to a private owner." However, in certain cases, a general would languish in price long enough that BPL would come to own the majority of the company's outstanding shares, typically through buying over many years. When this happens, these can become controls. Buffett had no problem becoming the majority holder and saw it as a logical extension of his approach, grounded in what a reasonable private owner would pay for the entire business. Potentially becoming that private owner simply increased his degrees of freedom. This was, after all, the two strings to his bow advantage that made the category of general's private owner so attractive in the first place, and helped make the partnership unique. While the price paid for the general offered an attractive margin of safety in its own right, the riskiness of the investment was further reduced by the potential for control. Oftentimes, as we've discussed, controls required Buffett to roll up his sleeves and become confrontational, similar in some ways to what we see activist investors doing today. Perhaps this is why he eventually stopped doing it. His activist period was limited to his time running BPL. For example, he had to threaten Sanborn Map's board with a proxy fight, legal battle, to get them to act. Interacting with a board not focused on shareholder value made Buffett's blood boil. At Dempster Mill, we'll see that he had to fire the CEO and bring in his own man, Harry Bottle. Together, they liquidated large parts of the business to restore the economics of the company. Buffett was vilified in the local newspaper for doing so. While he saw himself as saving the business by excising the rotten parts, critics only saw the lost jobs. Early at Berkshire, he had to fire the CEO and hit the brakes on capital expenditures in textiles, before redirecting the company's focus to insurance and banking. It was never easy and was often stressful, but when action was needed, action was taken. As he said, "Everything else being equal, I would much rather let others do the work. However, when an active role is necessary to optimize the employment of capital, you can be sure we will not be standing in the wings." Not only was Buffett willing to get active by exercising his ability to control a company, but he was also ready to concentrate heavily in them. With a say in how the company was being managed, the downside was limited. The value of the securities alone virtually guaranteed he would make money. When Buffett saw a highly favorable situation like Sanborn, where the upside was significant and the risk of loss was tiny, he was not afraid to load up and bet huge. By 1959, this position accounted for 35% of the partnership. The value was clearly there. All he had to do was get it out. In Sanborn, Buffett was by far the largest shareholder, but he was not the majority holder. Other shareholders collectively still owned more than half the company. In other cases, however, the partnership did have a majority, which meant full control. Here, Buffett could not be overruled. We see this first with Dempster Mill, a farm implements company that was purchased over a 5-year span and moved from generals to controls in 1961. When Buffett controlled 70% of the outstanding stock, he was quick to point out that his own actions in such a market could drastically affect the quoted price. The same was true when he came to own a majority of Berkshire. With a market as thin as it was in these two stocks, even a minor amount of buying or selling could have dramatic impact on the quoted price. Diversified Retailing Company, DRC, was a privately owned business acquired late in the partnership that never had a publicly traded stock. The value had to be estimated in all three. When a controlling interest is held, we own a business rather than a stock, and a business valuation is appropriate. In the absence of a reliable market value to account for the control company's year-end worth, Buffett had no other choice but to perform his own valuation. This could be a major positive in down markets because it insulated the carrying value of the position, and BPL, from the vagaries of the market. In sharply up markets, the valuation approach would hold back results. Either way, Mr. Market was no longer in charge. The value of each control was dictated solely by an ongoing appraisal of the private market value of the business performed by Buffett and confirmed by the auditors annually. Year-end valuations were a current conservative appraisal, not what he thought the controls were going to be worth in the future. As he told partners, "The estimated value should not be what we hope it would be worth, or what it might be worth to an eager buyer, etc., but what I would estimate our interest would bring if sold under current conditions in a reasonably short period of time." Remember that partners could only add or withdraw their capital once a year, so this valuation, particularly when it accounted for a third or more of partnership assets, was a big deal. Because the market determined the year-end valuation of the partnership's position in the generals and the workouts, it was simple and straightforward to know what these were worth. Valuing controls, on the other hand, required an estimated value, a very different kind of thing than a market value. Control valuations are subject to interpretation and dispute. No exact correct answer exists. If Buffett overvalued a control, it would inflate his performance and his performance fee, which would be harmful to all his partners. Those who left the partnership in a year where the estimated value was too high would also benefit at the expense of the remaining partners. On the flip side, if Buffett was too conservative in his valuation, partners adding capital would benefit at the expense of those leaving or not adding a proportionate amount of funds to the partnership themselves. Buffett was very careful to ensure his valuations were fair to both adding and withdrawing partners, and the results were audited by the accounting firm that would later become KPMG. The November 1966 letter gave the most detailed account of the mechanics of his appraisals. The dominant factors affecting control valuations are earnings power, past and prospective, and asset values. The nature of our controlled businesses, the quality of the assets involved, and the fact that the federal income tax basis applicable to the net assets substantially exceeds our valuations cause us to place considerably more weight on the asset factor than is typical in most business valuations. The partnership agreement charges me with the responsibility for establishing fair value for controlling interests, and this means fair to both adding and withdrawing partners at a specific point in time. Wide changes in the market valuations accorded stocks at some point obviously find reflection in the valuation of businesses, although this factor is of much less importance when asset factors, particularly when current assets are significant, overshadow earnings power considerations in the valuation process. Notice here that Buffett says that the nature of BPL's controls caused him to place considerably more weight on the asset factor than is typical in most business valuation. Sanborn, Dempster, and Berkshire were all asset plays. The value of their assets, less all liabilities, far exceeded the market price of the stocks. These were not good businesses, didn't earn adequate or better returns on the assets they employed, and were not readily valued on current earnings. If they were, a reasonable study of the past and prospective earnings of the business would play a more dominant role. Valuing a business on assets. Many of Buffett's controls earned little or were losing money. These early cigar butts required Buffett to employ Graham's method for adjusting the carrying values of the assets as reported on the company's balance sheets to uncover their true worth. While it was mostly statistically based, the adjustment still required a little art to go along with the science. Chapter 43 of Securities Analysis set up the basis for this method perfectly. According to Graham, a company's balance sheet does not convey exact information as to its value in liquidation, but it does supply clues or hints which may prove useful. The first rule in calculating liquidating value is that the liabilities are real, but the value of the assets must be questioned. This means that all true liabilities shown on the books must be deducted at their face amount. The value to be ascribed to the assets, however, will vary according to their character. For the liquidation plays, Graham advised, as a general rule of thumb, ascribing 100 cents on the dollar to cash, 80 cents on the dollar to receivables, 67 cents on the dollar for inventory, with a wide range depending on the business, and 15 cents on the dollar for fixed assets. As we dive into Buffett's detailed accounts of Sanborn Map, and later Dempster Mill and Berkshire Hathaway, we'll explore how Buffett went about ascribing values to the assets of each company. Sanborn had a hidden asset in its portfolio of securities that was worth far more than the balance sheet suggested. Convention at the time was to carry securities at cost, not market price, so the value had to be marked up. Dempster Mill's assets, net of all liabilities, were carried on the balance sheet at values that were significantly higher than the total value of the stock in the market. The accounting values were plain as day. The question Buffett encountered was, what were the assets really worth? With Berkshire, the question was, how could the capital in the business be redeployed to better use? The art for Buffett, as it is for all investors, is to evaluate the character of the assets properly, thinking it through, and making the appropriate adjustments when these differ from accounting values, values that only reflect facts around what the business itself had paid for the assets and the wear and tear, depreciation, since they were acquired. Adjusting asset values, up or down. A simplified example may help to illuminate how the process works. Imagine a ticket broker who has purchased 5 World Series tickets for $1,000, $200 each, that are valid only at Yankee Stadium. If the Yankees make it to the series, the tickets will be worth a lot. If they don't, the tickets will be worthless. In terms of the accounting, our ticket broker follows convention and records each ticket as an asset on the balance sheet at its cost. Now let's say this entire business comes up for sale with a month left to go in the baseball season. What would you say it's worth? To make it easier, let's assume the 5 tickets are the only assets in the business and that it has borrowed $300 to help acquire them. Whatever you think the assets are worth, less the debt, will be your valuation for the company. As Professor Greenblatt likes to tell his students at Columbia Business School, which remains the intellectual center of value investing, if you do good valuation work, and you are right, Mr. Market will pay you back. The process you take when valuing the ticket broker, or any business, will determine the quality of your investment results and lies at the heart of the value investing process. The initial question is always the same: are you capable of estimating what these assets are worth? Or, as Buffett would put it, are you within your circle of competence? If the answer is no, forget it and move on to valuing something else. There is nothing wrong with that. In fact, you should take pride in knowing what you are and are not capable of valuing. This self-knowledge is what distinguishes the great investors, and avoiding mistakes is just as important as doing a good job picking winners. Buffett puts the majority of potential investments into the too hard to value pile and simply moves on. What do we see in the financials of our ticket broker? We know the liabilities are fixed. That's always the easy part. We have $300 in debt. We also know the tickets were bought for $1,000, and so we'll see them as assets recorded at cost on the balance sheet. $1,000 in assets less $300 in debt leaves a balance $700 of owner's equity, or book value. Just because the assets were purchased at $1,000 doesn't mean that's what they're worth now. Circumstances may have changed. All the balance sheet shows is what has happened in the past. When you do your valuation work, the assets, tickets in our example, are always worth what they can be sold for, and the liabilities are always assumed to be due in full. That's the difference between accounting value and economic or true intrinsic value. In some cases, particularly when the business is of a poor quality, assets will be worth less than their carrying value. Recall, Graham advised ascribing 100 cents on the dollar to cash, 80 cents on the dollar to receivables, 67 cents on the dollar for inventory, with a wide range depending on the business, and 15 cents on the dollar for fixed assets. That's just a rough rule. You need to make your own logical assessment. You wouldn't logically pay a penny more than $200 for the broker business if the Yankees were way out of the running with 10 games to go and StubHub showed similar tickets selling for $100 each, making the broker's 5 worth $500 in total. With Dempster Mill, Buffett encountered just such a situation. In 1961, its book equity was $76, making the stock look ridiculously cheap at $28, at least on paper. Watching Buffett skillfully mark down Dempster's assets is a good chance to watch him in action, as he conservatively assesses true market values line by line. Here, even after his markdowns, Buffett found the stock was still exceedingly cheap. In other cases, often when the business is a good one, the balance sheet figures significantly understate the economic value of the assets. Getting back to our ticket broker example, what if the Yankees were a lock for the series, and StubHub was listing similar tickets at $500 each, $2,500 total? While the book value will always be $700 in either case, the true liquidation value in this instance would be $2,200. This is what Buffett saw at Sanborn Map, who had acquired a portfolio of securities that were being carried on the books at their cost, not at their market value. Because the securities had appreciated, they were worth a lot more than the amount reflected on the balance sheet. Through Sanborn, we get a chance to see Buffett recast the financials up, demonstrating how he found a stock where he could pay 70 cents on the dollar for a securities portfolio, with the rest of the business coming for free. Business's activity ties directly to value. Estimating the economic or true value of assets, as opposed to relying on the accounting values, the market price, or the opinions of others, is the art of investing in generals and controls. The process is the same whether you are valuing a slice of a business, stock, or the whole thing. However, when you are a minority holder, you're at the mercy of the existing management and the board of directors. While it's their job to act in the best interest of shareholders, they don't always live up to their responsibilities. This is the potential agency cost you bear when you don't have control, and the reason why an evaluation of management can be a very important part of your investment decision. With control comes the added ability to take charge, which is a real advantage when change is needed. By turning generals into controls, Buffett was able to change the behavior of companies. He stopped the value-destructive activities at Dempster and Berkshire. He fixed the lopsided capital structure of Sanborn Map. Through the controls, we not only get to see how Buffett came to recognize undervalued securities, but how he made businesses more valuable by improving the returns on the capital, assets, they employed. In an optimally run business, the value of control to a financial buyer is zero. The right to force change is valuable only when something needs fixing. All three controls offered significant opportunities for improvement. Coattailing. Some of the best situations arise when you find a general where you can make a significant investment of your own, but some other investor is doing the work to improve management's decision-making. Today, activists are still agitating managements to improve their operations. In fact, it's become a very popular strategy that has gained a lot of attention. The funds dedicated to this activity have attracted a lot of assets. Carl Icahn, Nelson Peltz, Dan Loeb, and Bill Ackman, among others, have garnered quasi-rock star status as investors. However, not all activists are worth following, and Buffett spoke disparagingly about the activists of today at the 2015 Berkshire meeting, saying that most of what he sees nowadays is really reaching, meaning he sees their demands as not necessarily in the interest of the long-term shareholders. In the partnership era, Buffett was at times clearly more influential than today's activists because he controlled a much larger amount of stock. The companies he was involved with were also smaller and far cheaper. Today, many activists take much smaller stakes in much larger companies and advocate for change through open letters to management and in other highly visible ways, hoping to gain support from shareholders at large. Then and now, though, the key issue is what the potential is for more value in a security than what's being ascribed by the market and then doing something to close the gap. Just like we saw with the partnership's investments, these situations can often get hostile. Today, one only needs to look at activist investors such as Nelson Peltz and his firm Trian's epic battle with DuPont. These two groups are in a very public, high-stakes slugfest. Trian's capital, and probably the DuPont CEO's job, are on the line. Trian wants major cost savings initiatives and potentially a breakup of the company. DuPont's CEO wants to keep the current strategy in place. Investors have to decide for themselves who is right. Here, Graham would say, "The public must learn to judge such controversies on their merits, as developed by statements of fact and by reasoned argument. It must not allow itself to be swayed by mere accusation or by irrelevant personalities." Investors today can undertake a careful study of the modern activists and their track records. Then, when you see an activist make a move, judge the merits of his argument on your own. If you agree, going along for the ride can be a great strategy. By coattailing an activist, value can often be unlocked at a much more rapid rate than would otherwise be the case if the status quo were preserved. In the case of DuPont, for example, the company quickly discovered a huge amount of cost savings, found on their own, so they said, immediately after Trian went public with their campaign. The mere presence of an activist is sometimes enough to spur value-creating changes from a management team. The activists who work in the best long-term interest of all shareholders play an important role in reducing the agency costs that naturally arise from non-owner management teams. We should be glad that someone is willing to take on this role. All else being equal, Buffett would rather let others do the work. But as he said, just be careful whose coattail you're riding. Buffett never did a hostile deal after the partnership. Conventional wisdom is that his funds had grown too big, or that he found a better, higher return strategy. I think there was more to it than that. His funds didn't grow beyond the largest of today's activist funds, in constant dollars, until many years after BPL closed. He has also said that the methods he used during the BPL era would still work well today, and we have evidence to support that claim through the current returns seen by the activists. While there is no doubt that Buffett came to prefer owning a whole business as opposed to slices of them, who wouldn't? His writing suggests he gave up the cigar butt controls more because he didn't like doing it than because he found some higher return for his investing dollars. In fact, giving them up probably shaved a few points off his annual returns in the early years, a choice he seemed more than comfortable with. Why trade even a little bit of misery for an extra point or two of return when you're already rich? I think you can see this in the comments he made late into the partnership, not long before he decided to close BPL. The satisfying nature of our activity in controlled companies is a minor reason for the moderated investment objectives discussed in the October 9th letter. When I am dealing with people I like, in businesses I find stimulating, what business isn't, and achieving worthwhile overall returns on capital employed, say 10 to 12%, it seems foolish to rush from situation to earn a few more percentage points. It also does not seem sensible to me to trade known pleasant personal relationships with high-grade people at a decent rate of return for possible irritation, aggravation, or worse, at potentially higher returns. There is nothing wrong with activist investing, to use a Munger phrase, if you can stand shaving. If done properly, it seems to yield a few more percentage points of annual return for activists today as it did for Buffett when he was doing it. Spotting the right activist who is making a sound argument in a situation in need of their focus can be a wonderful investment strategy. Just be sure to think it through for yourself. Don't follow blindly. Again, be careful whose coattails you are riding. Lessons from the Partnership Letters. Controls. January 24, 1962. The final category is control situations where we either control the company or take a very large position and attempt to influence policies of the company. Such operations should definitely be measured on the basis of several years. In a given year they may produce nothing, as it is usually to our advantage to have the stock be stagnant market-wise for a long period while we are acquiring it. These situations, too, have relatively little in common with the behavior of the Dow. Sometimes, of course, we buy into a general with the thought in mind that it might develop into a control situation. If the price remains low enough for a long period, this might very well happen. If it moves up before we have a substantial percentage of the company's stock, we sell at higher levels and complete a successful general operation. We are presently acquiring stock in what may turn out to be control situations several years hence. January 18, 1964. Unless we start off with the purchase of a sizable block of stock, controls develop from the general category. They result from situations where a cheap security does nothing price-wise for such an extended period of time that we are able to buy a significant percentage of the company's stock. At that point, we are probably in a position to assume some degree of, or perhaps complete, control of the company's activities. Whether we become active or remain relatively passive at this point depends upon our assessment of the company's future and the management's capabilities. The general we have been buying the most aggressively in recent months possesses excellent management following policies that appear to make very good sense to us. If our continued buying puts us in a controlling position at some point in the future, we will probably remain very passive regarding the operation of this business. We do not want to get active merely for the sake of being active. Everything else being equal, I would much rather let others do the work. However, when an active role is necessary to optimize the employment of capital, you can be sure we will not be standing in the wings. Active or passive, in a control situation there should be a built-in profit. The sine qua non of this operation is an attractive purchase price. Once control is achieved, the value of our investment is determined by the value of the enterprise, not the oftentimes irrationalities of the marketplace. Our willingness and financial ability to assume a controlling position gives us two-way stretch on many purchases in our group of generals. If the market changes its opinion for the better, the security will advance in price. If it doesn't, we will continue to acquire stock until we can look to the business itself rather than the market for vindication of our judgment. Investment results in the control category have to be measured on the basis of at least several years. Proper buying takes time. If needed, strengthening management, redirecting the utilization of capital, perhaps effecting a satisfactory sale or merger, etc., are also all factors that make this a business to be measured in years rather than months. For this reason, in controls, we are looking for wide margins of profit. If it looks at all close, we pass. Controls in the buying stage move largely in sympathy with the Dow. In the later stages, their behavior is geared more to that of workouts. January 18, 1964. If there is any trend as our assets grow, I would expect it to be toward controls, which heretofore have been our smallest category. I may be wrong in this expectation. A great deal depends, of course, on the future behavior of the market, on which your guess is as good as mine. I have none. At this writing, we have a majority of our capital in generals, workouts rank second, and controls are third. January 18, 1965. An investment operation that depends on the ultimate buyer making a bum deal, in Wall Street they call this the bigger fool theory, is tenuous indeed. How much more satisfactory it is to buy at really bargain prices so that only an average disposition brings pleasant results. January 20, 1966. The control section of our business received a transfer member from our private owner category. Shares in Berkshire Hathaway had been acquired since November 1962 on much the same line of reasoning as prevailed in the security mentioned above. In the case of Berkshire, however, we ended up purchasing enough stock to assume a controlling position ourselves, rather than the more usual case of either selling our stock in the market or to another single buyer. Our purchases of Berkshire started at a price of $7.60 per share in 1962. This price partially reflected large losses incurred by the prior management in closing some of the mills made obsolete by changing conditions within the textile business, which the old management had been quite slow to recognize. In the post-war period, the company had slid downhill a considerable distance, having hit a peak in 1948 when about $29.5 million was earned before tax and about 11,000 workers were employed. This reflected output from 11 mills. At the time we acquired control in spring of 1965, Berkshire was down to 2 mills and about 2,300 employees. It was a very pleasant surprise to find that the remaining units had excellent management personnel, and we have not had to bring a single man from the outside into the operation. In relation to our beginning acquisition cost of $7.60 per share, the average cost, however, was $14.86 per share, reflecting very heavy purchases in early 1965. The company, on December 31, 1965, had net working capital alone, before placing any value on the plants and equipment, of about $19 per share. Berkshire is a delight to own. There is no question that the state of the textile industry is the dominant factor in determining the earning power of the business. But we are most fortunate to have Ken Chase running the business in a first-class manner, and we also have several of the best salespeople in the business heading up this end of their respective divisions. While a Berkshire is hardly going to be as profitable as a Xerox, Fairchild Camera, or National Video in a hyper-tensed market, it is a very comfortable sort of thing to own. As my West Coast philosopher says, it is well to have a diet consisting of oatmeal as well as cream puffs. Because of our controlling interest, our investment in Berkshire is valued for our audit as a business, not as a marketable security. If Berkshire advances $5 per share in the market, it does BPL no good. Our holdings are not going to be sold. Similarly, if it goes down $5 per share, it is not meaningful to us. The value of our holding is determined directly by the value of the business. I received no divine inspiration in that valuation of our holdings. Maybe the owners of the 3 wonder stocks mentioned above do receive such a message in respect to their holdings. I feel I would need something at least that reliable to sleep well at present prices. I attempt to apply a conservative valuation based upon my knowledge of assets, earning power, industry conditions, competitive position, etc. We would not be a seller of our holdings at such a figure, but neither would we be a seller of the other items in our portfolio at year-end valuations, otherwise we would already have sold them. January 25, 1967. There were 3 main sources of gain during 1966 in respect to controlled companies. These arose through 1. Retained business earnings applicable to our holdings in 1966, 2. Open market purchases of additional stock below our controlling interest valuation, and 3. Unrealized appreciation in marketable securities held by the controlled companies. The total of all positive items came to $2,600,838 in 1966. However, due to factors mentioned in my November 1, 1966 letter, specific industry conditions, and other relevant valuation items, this gain was reduced by $1,034,780 in arriving at our fair valuation applicable to controlling interests as of December 31, 1966. Thus, the overall gain in the control category was reduced to $1,566,058 for the year. We were undoubtedly fortunate that we had a relatively high percentage of net assets invested in businesses and not stocks during 1966. The same money in general market holdings would probably have produced a loss, perhaps substantial, during the year. This was not planned, and if the stock market had advanced substantially during the year, this category would have been an important drag on overall performance. The same situation will prevail during 1967. January 22, 1969. Overall, the controlled companies turned in a decent performance during 1968. Diversified Retailing Company Incorporated, 80% owned, and Berkshire Hathaway Incorporated, 70% owned, had combined after-tax earnings of over $5 million. Particularly outstanding performances were turned in by Associated Cotton Shops, a subsidiary of DRC run by Ben Rosner, and National Indemnity Company, a subsidiary of BH run by Jack Ringwalt. Both of these companies earned about 20% on capital employed in their businesses. Among Fortune's 500, the largest manufacturing entities in the country starting with General Motors, only 37 companies achieved this figure in 1967, and our boys outshone such mildly better known, but not better appreciated, companies as IBM, General Electric, General Motors, Procter & Gamble, DuPont, Control Data, Hewlett-Packard, etc. I still sometimes get comments from partners like, "Say, Berkshire is up 4 points, that's great," or "What's happening to us? Berkshire was down 3 last week." Market price is irrelevant to us in the valuation of our controlling interests. We valued BH at 25 at year-end 1967, when the market was about 20, and 31 at year-end 1968, when the market was about 37. We would have done the same thing if the markets had been 15 and 50, respectively. Price is what you pay, value is what you get. We will prosper or suffer in controlled investments in relation to the operating performances of our businesses. We will not attempt to profit by playing various games in the securities markets. Whether you run a business, own a business, or are in a business through a partial claim, stock, Buffett's commentary on controls helps you learn to think like an owner. It also helps you do asset-based valuation work along the same lines, as if you're buying the entire thing. Next, we will look at Dempster Mill, which is the control that Buffett spent the most time discussing in the letters. It's a perfect case study that delves deeper into these ideas. We can see how assets are first evaluated, then redeployed to enhance the returns of the business and unlock significant shareholder value. Chapter 9. Dempster Diving, the Asset Conversion Play. We are looking for wide margins of profit. If it looks at all close, we pass. January 18, 1964. Much of the fun in investing comes from the hunting process itself. Finding a net-net situation as cheap as Dempster Mill is akin to the art dealer who finds a Renoir underneath a painting of dogs on velvet selling for $25 at an estate sale. It's an exceedingly rare event, requires a little work to see the real value, and at that price it's sure to produce a huge profit. Picture the pulse-quickening moment in 1956 when Buffett, thumbing through the Moody's manual, came across a tiny, obscure manufacturing company whose stock had fallen 75% in the previous year. Realizing that it was now available for a fraction of its net working capital and an even smaller fraction of its book value, he started buying the stock as low as $17 a share. He got out at $80. Buffett's commentary on the saga of Dempster Mill was the most complete account of any investment he made for the partnership. It perfectly captures his early investing process and illuminates how he implemented Graham's quantitative style of investment. Dempster was a concentrated investment. It was cheap even on conservative assumptions. It required Buffett's active involvement. It was an asset conversion play, and it was executed in a tax-advantaged way. For those who remain in the quantitative, General's private owner school of investing, a close look at Dempster serves as a template for valuing businesses using the asset value method in the undervalued cigar butt plays of today. Windmill wind down. Buffett started buying stock soon after he formed the very first partnership. The Moody's manual that year described Dempster as a manufacturer of windmills, pumps, cylinders, water systems, centrifugal pumps, steel tanks, water supply equipment, fertilizer equipment, and farm implements. It was a microcap, family-owned company in Beatrice, Nebraska, generating de minimis profits. The equity, however, would have caught the discriminating eye of any Graham disciple. It was trading at a momentous discount. Not long after his first purchase, Buffett joined the company's board of directors, and he kept buying the stock for the next 5 years. Then a large block from the Dempster family came up for sale in 1961. Control was acquired in August of that year. He owned 70%, and a few associates owned another 10%. All in, his average price was $1.2 million, $28 per share, which was roughly a 50% discount to working capital and 66% discount to book. For the purposes of the partnership, he placed a $35 per share liquidation value on the company, a process that was of particular importance, since, in effect, new partners are buying in based upon this price, and old partners are selling a portion of their interest based upon the same price. Dempster accounted for roughly 20% of BPL's total assets at year-end. This was yet another big commitment for Buffett and a tricky situation at first. Inventories were way too high and rising fast. Buffett tried to work with existing management, but finally had to throw them out as inventories continued to build. The company's bank was worried and threatening to seize the collateral backing its loan. They began talking about shutting Dempster down, and Buffett had to act fast. If a business tying up 20% of his capital went under, the partnership would be in serious trouble. Thankfully, on the recommendation of Munger, Buffett met an operating man named Harry Bottle and hired him on the spot. Harry was a turnaround specialist and quickly got to work. Here he recalled handling the excess inventory problem. In desperation, I simply hired a painter, and with his help we painted a 6-inch white line 10 feet above the floor around the inside wall of our largest warehouse, and I called in the plant supervisor and informed him that if I ever walked into the building and could not see the line above the pile of boxes, I would lay off everyone, except the shipping department, until the line was exposed. I gradually moved that line down until I arrived at a satisfactory inventory turn. Harry did such an outstanding job whipping the company into shape that Buffett, in the next year's letter, named him Man of the Year. Not only did he reduce inventories from $4 million to $1 million, alleviating the concerns of the bank, whose loan was quickly repaid, he also cut administrative and selling expenses in half and closed 5 unprofitable branches. With the help of Buffett and Munger, Dempster also raised prices on their used equipment up to 500%, with little impact to sales volume or resistance from customers, all of which worked in combination to restore a healthy economic return in the business. Flexible thinking. There is an added twist to Dempster that distinguished Buffett from the vast majority of his contemporaries and demonstrates the flexibility of his thought process. He understood his job as a business owner and his job as an investor to be one and the same. Most people think of themselves in one role or the other. It clicked with Buffett early that the roles are one and the same in that both are capital allocators. Too often, managers of poor return businesses feel they have no other choice but to reinvest profits back into their business. Then they judge their success relative to industry peers. This can often lead to the healthiest person in hospice syndrome, where good money is reinvested at low incremental rates of return and serves only to perpetuate a continuation of poor returns. Buffett was wired differently, and he achieves better results in part because he invests using an absolute scale. With Dempster, he wasn't at all bogged down with all the emotional baggage of being a veteran of the windmill business. He was in it to produce the highest rate of return on the capital he had tied up in the assets of the business. This absolute scale allowed him to see that the fix for Dempster would come by not reinvesting back into windmills. He immediately stopped the company from putting more capital in and started taking the capital out. With profits and proceeds raised from converting inventory and other assets to cash, Buffett started buying stocks he liked. In essence, he was converting capital that was previously utilized in a bad, low-return business, windmills, to capital that could be utilized in a good, high-return business, securities. The longer it went on, the less Dempster looked like a manufacturing company, and the more it looked like the investment partnership. The willingness and ability to see investment capital as completely fungible, whether it is capital tied up in the assets of a business or capital that's invested in securities, is an exceedingly rare trait. With Buffett at the helm, he saw to it that assets that could be redeployed were redeployed. Then he had the company borrow $20 a share, which was used to buy even more of the stocks he liked. The initial $35 valuation in 1961 was all Dempster. By year-end 1962, Buffett's valuation, now $51 a share, comprised securities at market worth $35 and the manufacturing operations at $16. Dempster's securities portfolio had become as large as the rest of the partnerships. Buffett gave fair warning of the natural consequences of this change. It should be pointed out that Dempster last year was 100% an asset conversion problem, and therefore completely unaffected by the stock market and tremendously affected by our success with the assets. In 1963, the manufacturing assets will still be important, but from a valuation standpoint, it will behave considerably more like a general since we will have a large portion of its money invested in generals, pretty much identical with those in Buffett Partnership Limited. Dempster was Buffett's first experience jumping into the management of a control with both feet, and Bottle gave him a first-hand view of the difference a high-quality, trustworthy CEO could make. Harry Bottle was showered with praise in the letters. Here we see the origins of what later became Buffett's signature style, borrowed from Dale Carnegie. Praise by name, criticize by category. Buffett and Bottle continued to work down the assets of Dempster until all that was left was earning a satisfactory return. Then the story ended in 1963. Dempster's remaining manufacturing assets, as well as the Dempster name, were sold. One final facet of the story demonstrates Buffett's acumen for maximizing after-tax profits. Because all the manufacturing assets were gone, only securities remained. Buffett was able to avoid Dempster's corporate capital gains tax bill in a move that effectively doubled BPL's return, allowing BPL to realize a $45 per share gain. While the Dempster investment was very profitable, Buffett never did another one like it. He was vilified in the local press as a liquidator. Later, when faced with the question of whether to liquidate Berkshire's textiles business in 1969, he said, "I don't want to liquidate a business employing 1,100 people when the management has worked hard to improve their relative industry position with reasonable results, and as long as the business does not require substantial additional capital investment. I have no desire to trade severe human dislocations for a few percentage points additional return per annum." Dempster diving contemporaries. Watching Buffett put his investing knowledge to work through Dempster is instructive for today's investors on several levels. First, it reveals a false assumption many harbor about controls being a field limited to big investors. Dempster's market value was $1.6 million in 1961, or approximately $13.3 million in today's dollars. Second, the ability to play in the smaller sandboxes was as big an advantage for him in the early years as it remains for anyone working with smaller sums today. The two strings to the bow advantage of the General's private owner stocks allows for activism as well as control. Even those working with smaller sums can exercise this advantage in the micro-cap companies. Buffett was not the only investment legend to make his start in deeply undervalued securities. David Einhorn, who founded the now colossal hedge fund Greenlight Capital in 1996 with less than $1 million, identified a micro-cap net company by the name of C.R. Anthony, trading at 50% of net working capital. Einhorn put 15% of his assets into it and ended up making a 500% return that year when the company was acquired. As a billionaire, those types of opportunities are unlikely to become available to him again. Industry experts point out how difficult it would be to put more than $1 million to work in a diversified net strategy in 2014. If you're not too wealthy for it already, happy hunting. Value. Accounting value versus intrinsic value. Today, plenty of free internet tools exist to screen for stocks trading below their accounting book value or their net working capital. Buying an equal-weighted basket of these types of properly selected stocks and holding them for a year or two, one of Tobias Carlyle's strategies, has proven to be very effective historically. But if you want to make more concentrated bets like Buffett did, you're going to have to do some analysis, and that starts with understanding the actual economic value, realizable liquidation value, of a company's assets. The Dempster-related letters are rich with specific detail about the actual process Buffett used to value the assets of these kinds of troubled companies. It remains the same process deep value investors are using today. The Dempster description was unique because we not only see his initial appraisal of value on a line-by-line basis, we also can see how those values changed as events unfolded. Importantly, when it comes to an asset as opposed to an earnings valuation, we are talking about conservatively calculated liquidation value. The estimated value should not be what we hope it would be worth or what it might be worth to an eager buyer, etc., but what I would estimate our interest would bring if sold under current conditions in a reasonably short period of time. The process comes straight from Graham. As can be seen in Appendix D in the accompanying PDF enhancement, Buffett works progressively down the list of balance sheet items which are listed according to their liquidity. Cash is so liquid it doesn't need a haircut. Accounts receivable, money owed by Dempster's customers but not yet collected, are valued at 85 cents on the dollar. Inventory, which is carried on the books at cost, is marked down to 65 cents. Prepaid expenses and other are assumed to be worth only 25 cents on the dollar. When the adjusted figures are summed, you can see that Buffett is assuming a real-world value of $3.6 million for the current most liquid assets, despite the fact they are on the books at $5.5 million. Next, he values the long-term assets, which are typically less liquid using estimated auction values. For Dempster, these would be the manufacturing facilities and equipment, officially listed as property, plant, and equipment. Notice the $800,000 valuation compared to $1.4 million of accounting value. Remember, Buffett's after what this stuff is worth in the event of a prompt sale. Accounting values tell you only what price was paid by the company to acquire this stuff. He was after the price that would be paid to the company if sold. The process is intentionally conservative so as to leave room for a margin of error in the assumptions. Some companies will require more conservatism than others. For example, a retailer with an inventory of mostly out-of-fashion T-shirts needs a much bigger discount than would be required for inventory of a manufacturer made up of unfinished commodities, steel plating, for example. You can do a little research to help find more accurate adjustment factors by industry. Securities analysis dives deeply into the intricacies of asset valuation. For our purposes, it's sufficient if you grasp the basics of how the process works and the importance of erring on the side of caution in your estimates. That means, once you do the work, the value should be obvious. As Buffett said in the letters, "We are looking for wide margins of profit. If it looks at all close, we pass." As evident in the table in the appendix and the accompanying PDF enhancement, adjusted assets totaled $4.4 million. When liabilities of $2.3 million were subtracted, always at face value, $2.2 million was left as the adjusted business value. With 60,000 shares, this works out to the initial $35 per share valuation. Buffett's average price of $28 was equal to 80% of his conservatively calculated adjusted liquidation value. In other words, while it was a ridiculously low price relative to its accounting value, more important, it was still meaningfully cheap relative to the adjusted or intrinsic value. A living valuation. In the 6 months that Harry Bottle was on the job, he was able to make significant progress turning around the company, and again we can see in the table in the appendix how his progress made Dempster a more valuable company. Buffett delighted in reporting, "The successful conversion of substantial portions of the assets of Dempster to cash, at virtually 100 cents on the dollar, has been the high point of 1962. For example, inventory of $4.2 million at last year-end will probably be about $1.9 million this year-end, reducing the discount on this item by about $920,000, 40% of $2.3 million reduction." Using the same adjustment factors on each item reveals exactly how this activity produced another $15 a share in value. Buffett walked partners through the figures. 3 facts stand out. 1. Although net worth has been reduced somewhat by the house cleaning and write-downs, $550,000 was written out of inventory, fixed assets overall brought more than book value. We have converted assets to cash at a rate far superior to that implied in our year-earlier valuation. 2. To some extent, we have converted the assets from the manufacturing business, which has been a poor business, to a business which we think is a good business, securities. 3. By buying assets at a bargain price, we don't need to pull any rabbits out of a hat to get extremely good percentage gains. This is the cornerstone of our investment philosophy. Never count on making a good sale. Have the purchase price be so attractive that even a mediocre sale gives good results. The better sales will be the frosting on the cake. Never forget the balance sheet. Buffett teaches investors to think of stocks as a conduit through which they can own their share of the assets that make up a business. The value of that business will be determined by one of 2 methods. 1. What the assets are worth if sold, or 2. The level of profits in relation to the value of assets required in producing them. This is true for each and every business, and they are interrelated. Buffett commented, "Harry has continued this year to turn underutilized assets into cash, but in addition he has made the remaining needed assets productive." Operationally, a business can be improved in only three ways. 1. Increase the level of sales. 2. Reduce costs as a percent of sales. 3. Reduce assets as a percentage of sales. The other factors, 4. Increase leverage, or 5. Lower the tax rate, are the financial drivers of business value. These are the only ways a business can make itself more valuable. Buffett pulled all the levers at Dempster. Raising prices on replacement parts and reducing operating costs pulled lever number 1 and number 2. Lever number 3 was pulled as inventories, assets, were reduced. Lever number 4 was pulled when Buffett borrowed money to buy more stocks. Lever number 5 was pulled when he avoided a big tax bill by selling all the operating assets of the company. When profitability goes up and the capital required to produce it goes down, the returns and the value of the business go straight up. Buffett understood this intrinsically, and Dempster is a powerful example for today's investors who obsess over 1 and 2 at the expense of 3. Pulling underutilized assets out of a company not only produces cash to be used elsewhere, it makes the business better and more valuable. It is a wonderful reminder to individual and professional investors alike to focus their attention first on the balance sheet. There is a reason it comes first in the set of financial statements. Never lose sight of the fact that without tangible assets, there would be no earnings in the first place. Lessons from the Partnership Letters, Dempster Mill, July 22, 1961. We have also begun open market acquisition of a potentially major commitment which I, of course, hope does nothing market-wise for at least a year. Such a commitment may be a deterrent to short-range performance, but it gives strong promise of superior results over a several-year period combined with substantial defensive characteristics. January 24, 1962. Dempster Mill Manufacturing Company. We are presently involved in the control of Dempster Mill Manufacturing Company of Beatrice, Nebraska. Our first stock was purchased as a generally undervalued security 5 years ago. A block later became available, and I went on the board about 4 years ago. In August 1961, we obtained majority control, which is indicative of the fact that many of our operations are not exactly of the overnight variety. Presently, we own 70% of the stock of Dempster, with another 10% held by a few associates. With only 150 or so other stockholders, a market on the stock is virtually non-existent, and in any case would have no meaning for a controlling block. Our own actions in such a market could drastically affect the quoted price. Therefore, it is necessary for me to estimate the value at year-end of our controlling interest. This is of particular importance since, in effect, new partners are buying in based upon this price, and old partners are selling a portion of their interest based upon the same price. The estimated value should not be what we hope it would be worth or what it might be worth to an eager buyer, etc., but what I would estimate our interest would bring if sold under current conditions in a reasonably short period of time. Our efforts will be devoted toward increasing this value, and we feel there are decent prospects of doing this. Dempster is a manufacturer of farm implements and water systems, with sales in 1961 of about $9 million. Operations have produced only nominal profits in relation to invested capital during recent years. This reflected a poor management situation, along with a fairly tough industry situation. Presently, consolidated net worth, book value, is about $4.5 million, or $75 per share. Consolidated working capital about $50 per share, and at year-end we valued our interest at $35 per share. While I claim no oracular vision in a matter such as this, I feel this is a fair valuation to both new and old partners. Certainly, if even moderate earning power can be restored, a higher valuation will be justified, and even if it cannot, Dempster should work out at a higher figure. Our controlling interest was acquired at an average price of about $28, and this holding currently represents 21% of partnership net assets based on the $35 value. Of course, this section of our portfolio is not going to be worth more money merely because General Motors, U.S. Steel, etc. sell higher. In a raging bull market, operations and control situations will seem like a very difficult way to make money compared to just buying the general market. However, I am more conscious of the dangers presented at current market levels than the opportunities. Control situations, along with workouts, provide a means of insulating a portion of our portfolio from these dangers. November 1, 1962. We intend to use the same method for valuing our controlling interest in Dempster Mill Manufacturing at this year-end that we did at the end of last year. This involved applying various discounts to the balance sheet items to reflect my opinion as to what could be realized on a very prompt sale. Last year, this involved a 40% discount on inventories, a 15% discount on receivables, estimated auction value of fixed assets, etc., which led to an approximate value of $35 per share. The successful conversion of substantial portions of the assets of Dempster to cash at virtually 100 cents on the dollar has been the high point of 1962. For example, inventory of $4.2 million at last year-end will probably be about $1.9 million this year-end, reducing the discount on this item by about $920,000, 40% of $2.3 million reduction. I will give this story my full journalistic treatment in my annual letter. Suffice to say at this point that applying the same discounts described above will probably result in a year-end value of at least $50 per share. The extent of the asset conversion job can perhaps best be illustrated in a sentence by pointing out that whereas we had $166,000 of cash and $2,315,000 of liabilities at November 30th, 1961, Dempster fiscal year end, we expect this year to have about $1 million in cash and investments of the type the partnership buys against total liabilities of $250,000. Prospects for further improvement in this situation in 1963 appear good, and we expect a substantially expanded investment portfolio in Dempster next year. Valuing Dempster at $50 per share, our overall gain, before any payments to partners, to October 31st for the partnership has been 5.5%. This 22.3 percentage points advantage over the Dow, if maintained until the end of the year, will be among the largest we have ever had. About 60% of this advantage was accomplished by the portfolio other than Dempster, and 40% was the result of increased value at Dempster. January 18, 1963. Dempster Mill Manufacturing Company. The high point of 1962 from a performance standpoint was our present control situation, 73% owned Dempster Mill. Dempster has been primarily in farm implements, mostly items retailing for $1,000 or under, water systems, water well supplies, and jobbed plumbing lines. The operations for the past decade have been characterized by static sales, low inventory turnover, and virtually no profits in relation to invested capital. We obtained control in August 1961 at an average price of about $28 per share, having bought some stock as low as $16 in earlier years, but the vast majority in an offer of $30.25 in August. When control of a company is obtained, obviously what then becomes all important is the value of assets, not the market quotation for a piece of paper, stock certificate. Last year, our Dempster holding was valued by applying what I felt were appropriate discounts to the various assets. These valuations were based on their status as non-earning assets and were not assessed on the basis of potential, but on the basis of what I thought a prompt sale would produce at that date. Our job was to compound these values at a decent rate. The consolidated balance sheet last year and the calculation of fair value are shown in Appendix D, in the accompanying PDF enhancement. Dempster's fiscal year ends November 30th, and because the audit was unavailable in complete form, I approximated some of the figures and rounded to $35 per share last year. Initially, we worked with the old management toward more effective utilization of capital, better operating margins, reduction of overhead, etc. These efforts were completely fruitless. After spinning our wheels for about 6 months, it became obvious that while lip service was being given to our objective, either through inability or unwillingness, nothing was being accomplished. A change was necessary. A good friend, whose inclination is not toward enthusiastic descriptions, highly recommended Harry Bottle for our type of problem. On April 17, 1962, I met Harry in Los Angeles, presented a deal which provided for rewards to him based upon our objectives being met, and on April 23rd he was sitting in the president's chair in Beatrice. Harry is unquestionably the man of the year. Every goal we have set for Harry has been met, and all the surprises have been on the pleasant side. He has accomplished one thing after another that has been labeled as impossible, and has always taken the tough things first. Our break-even point has been cut virtually in half, slow-moving or dead merchandise has been sold or written off, marketing procedures have been revamped, and unprofitable facilities have been sold. The results of this program are partially shown in the balance sheet in Appendix D, in the accompanying PDF enhancement, which, since it still represents non-earning assets, is valued on the same basis as last year. On January 2, 1963, Dempster received an unsecured term loan of $1,250,000. These funds, together with the funds already freed up, will enable us to have a security portfolio of about $35 per share at Dempster, or considerably more than we paid for the whole company. Thus, our present valuation will involve a net of about $16 per share in the manufacturing operation and $35 in a security operation comparable to that of Buffett Partnership Limited. We, of course, are devoted to compounding the $16 in manufacturing at an attractive rate, and believe we have some good ideas as to how to accomplish this. While this will be easy if the business as presently conducted earns money, we have some promising ideas even if it shouldn't. It should be pointed out that Dempster last year was 100% an asset conversion problem, and therefore completely unaffected by the stock market and tremendously affected by our success with the assets. In 1963, the manufacturing assets will still be important, but from a valuation standpoint it will behave considerably more like a general, since we will have a large portion of its money invested in generals pretty much identical with those in Buffett Partnership Limited. For tax reasons, we will probably not put workouts in Dempster. Therefore, if the Dow should drop substantially, it would have a significant effect on the Dempster valuation. Likewise, Dempster would benefit this year from an advancing Dow, which would not have been the case most of last year. There is one final point of real significance for Buffett Partnership Limited. We now have a relationship with an operating man which could be of great benefit in future control situations. Harry had never thought of running an implement company 6 days before he took over. He is mobile, hard-working, and carries out policies once they are set. He likes to get paid well for doing well, and I like dealing with someone who is not trying to figure out how to get the fixtures in the executive washroom gold-plated. Harry and I like each other, and his relationship with Buffett Partnership Limited should be profitable for all of us. July 10, 1963. In our most recent annual letter, I described Harry Bottle as the man of the year. This was an understatement. Last year, Harry did an extraordinary job of converting unproductive assets into cash, which we then, of course, began to invest in undervalued securities. Harry has continued this year to turn underutilized assets into cash, but, in addition, he has made the remaining needed assets productive. Thus, we have had the following transformation in balance sheets during the last 19 months. See Appendix D in the accompanying PDF enhancement. I have included above the conversion factors we have previously used in valuing Dempster for BPL purposes to reflect estimated immediate sale values of non-earning assets. As can be seen, Harry has converted the assets at a much more favorable basis than was implied by my valuations. This largely reflects Harry's expertise and, perhaps to a minor degree, my own conservatism in valuation. As can also be seen, Dempster earned a very satisfactory operating profit in the first half, as well as a substantial unrealized gain in securities, and there is little question that the operating business as now conducted has at least moderate earning power on the vastly reduced assets needed to conduct it. Because of a very important seasonal factor, and also the presence of a tax carry-forward, however, the earning power is not nearly what might be inferred simply by a comparison of the 11/30/62 and 6/30/63 balance sheets. Partly because of this seasonality, but more importantly because of possible developments in Dempster before 1963 year-end, we have left our Dempster holdings at the same $51.26 valuation used at year-end 1962 in our figures for BPL's first half. However, I would be very surprised if it does not work out higher than this figure at year-end. One sidelight for the fundamentalists in our group: BPL owns 71.7% of Dempster, acquired at a cost of $1,262,577.27. On June 30, 1963, Dempster had a small safe deposit box at the Omaha National Bank containing securities worth $2,028,415.25. Our 71.7% share of $2,028,415.25 amounts to $1,454,373.70. Thus, everything above ground, and part of it underground, is profit. My security analyst friends may find this a rather primitive method of accounting, but I must confess that I find a bit more substance in this fingers and toes method than in any prayerful reliance that someone will pay me 35 times next year's earnings. A letter to the stockholders of Dempster Mill, not included in the partnership letters. July 20, 1963. Enclosed is the notice of a special meeting of the stockholders, to be held in Beatrice on Wednesday, July 31, 1963, at 7 p.m. This letter is written so that you will be in a position to give advance consideration to the matters that will be voted on at this meeting. Attached are financial statements showing the unaudited earnings for the first 7 months of the fiscal year, as well as a balance sheet showing the financial condition of the company on June 30, 1963. It is apparent that the fine job Harry Bottle started as president last year has been continued this year. There is a very substantial seasonal element to our business, so that operations at about break-even are expected during the balance of the year. Nevertheless, it appears that operations for the full year will result in one of the best years in recent history. This dramatic improvement in operating results has been produced by eliminating unprofitable lines, closing unprofitable branch locations, eliminating unneeded overhead, adjusting prices where warranted, etc. In addition to restoring the company to profitable operations, these actions have substantially reduced the capital needs of the business. Accordingly, on June 30th, we owned $1,772,000 of marketable securities, with a market value on that date of $2,028,000. It appears that the company will soon be in a position where only about 60% of its assets will be utilized in the manufacturing business. This overcapitalization presents important problems to the management in its efforts to produce a satisfactory return on the total capital committed to the corporation. The management has given consideration to many alternative methods of employing this capital in the business, as well as explored possibilities whereby these excess funds might be made directly available to shareholders without the imposition of very substantial ordinary income taxes. It appears to be impossible to make any pro-rate distribution without such a distribution being taxable as an ordinary dividend. Our legal advisors have recommended that the most effective way to placing this capital in the hands of Dempster stockholders would be through sale of the operating assets of the company as a going concern, to be followed by the liquidation of the corporation. This does not mean a liquidation of the operating business, for it will have been previously sold as a going concern. Then all funds may be distributed pro rata to stockholders, subject only to a capital gains tax on the excess amount received over each stockholder's tax basis of his stock. It is particularly recommended that this action be taken promptly, since the company has about exhausted the tax carry forward as computed by our auditors, and henceforth our operating profits will be subject to 52% federal income taxes. As it is now conducted, the Board of Directors unanimously believes the business of Dempster Mill has a value as a going business in excess of the mere liquidation value of its assets. Therefore, we believe it to be to the best interests of the stockholders, employees, and customers that it be sold as a going concern. Harry Bottle will be available as manager for any purchaser. He has been instructed to conduct operations during the intervening period before sale in a manner consistent with our plan of operation during the past year. Material will be purchased, production planed, etc., based on the same pattern as prevailed regarding products and distribution last year. Very recently there have been negotiations between the Executive Committee and representatives of several possible purchasers looking toward such a sale as a going business. These have not led to a contract, although in 2 cases differences seemed relatively minor. Currently the operations are being studied by an interested party whose intentions have been stated to us to involve substantial expansion of the Beatrice operation. Because of the seasonal nature of our business, it is necessary for any purchaser to take over operations in early fall to intelligently prepare for the big spring selling season. Therefore, your board feels something concrete should be done in the relatively near future. The enclosed notice of a special meeting describes the procedure to be followed. Through September 13th, our efforts will be continued to sell the business as a going concern on a negotiated basis. The intent to sell will be widely advertised immediately after the stockholders' meeting. It is intended that major companies in the pump, implement, and fertilizer field will be contacted. We will reserve the right to sell on a negotiated basis until September 13th. During this period, it will be possible to tailor a contract to the desires of a purchasing party. Failing a negotiated sale by September 13th, a public sale on September 30th will be held with a standard contract of sale, which we will provide, and to which all bidders must conform. Such a sale will be for cash. BPL, owner of 44,557 Dempster shares, presently intends to bid if this sale should take place and would arrange to enter into a partnership or joint venture with any other stockholder or group of stockholders in a bid, if they wanted to do so. Any stockholders of Dempster, of course, will be able to bid individually. We wish to emphasize, Dempster will be sold as an operating business, and the buyer will purchase the right to use the Dempster name in operation. After the sale, it is the present intention of the board to proceed with the orderly distribution of proceeds from the sale and from the disposition of other assets, except for those assets which may be conveniently distributed in kind. While it is obviously impossible to estimate what the final realization to stockholders may be, it would appear certain to be substantially higher than current or past quotations on Dempster stock. Therefore, it would appear advisable for stockholders to retain their shares, at least until further word as to how sales efforts have proceeded. We hope all stockholders can attend the special meeting so that all questions may be answered. If you cannot attend, any written questions will be answered promptly. Yours very truly, W.E.B., Chairman of the Board. November 6, 1963. In 1963, the heavy corporate taxes we were facing, Harry surprised me by the speed with which he had earned up our tax loss carry forward, coupled with excess liquid funds within the corporation, compelled us to either in some way de-incorporate or to sell the business. We set out to do either one or the other before the end of 1963. De-incorporating had many problems, but would have, in effect, doubled earnings for our partners and also eliminated the problem of corporate capital gain tax on Dempster securities. At virtually the last minute, after several earlier deals had fallen through at reasonably advanced stages, a sale of assets was made. Although there were a good many wrinkles to the sale, the net effect was to bring approximately book value. This, coupled with the gain we have in our portfolio of marketable securities, gives us a realization of about $80 per share. Dempster, now named First Beatrice Corp., we sold the name to the new company, is down to almost entirely cash and marketable securities now. On BPL's year-end audit, our First Beatrice holdings were valued at asset value with securities at market, less a $200,000 reserve for various contingencies. I might mention that we think the buyers will do very well with Dempster. They impress us as people of ability, and they have sound plans to expand the business and its profitability. We would have been quite happy to operate Dempster on an unincorporated basis, but we are also quite happy to sell it for a reasonable price. Our business is making excellent purchases, not making extraordinary sales. Harry works the same way I do. He likes big carrots. He is presently a limited partner of BPL, and the next belt-tightening operation we have, he's our man. The Dempster saga points up several morals. 1. Our business is one requiring patience. It has little in common with a portfolio of high-flying glamour stocks, and during periods of popularity for the latter we may appear quite stodgy. 2. It is to our advantage to have securities do nothing price-wise for months, or perhaps years, while we are buying them. This points up the need to measure our results over an adequate period of time. We suggest 3 years as a minimum. 3. We cannot talk about our current investment operations. Such an open-mouth policy could never improve our results and in some situations could seriously hurt us. For this reason, should anyone, including partners, ask us whether we are interested in any security, we must plead the Fifth Amendment. Compounded wisdom. Looking back on Dempster much later, Buffett has said that hiring Harry may have been the most important management decision I ever made. Dempster was in big trouble under the 2 previous managers, and the banks were treating us as a potential bankrupt. If Dempster had gone down, my life and fortunes would have been a lot different from that time forward. Not only is it an exciting story, but it's great to have the opportunity to peer over Buffett's shoulder and see how the investment evolves from year to year. The basic Graham techniques for valuing net-nets are found within the story, and then we see how Buffett pulled the 5 fundamental levers of business value to improve the company and make it worth more. In the next several chapters, attention will turn to the partnership's lessons on how to avoid some common mistakes in investing, such as confusing conventional thinking with true conservative action, overweighting taxes as a consideration, the impact of size on performance, and the importance of maintaining your investment marbles while those around you are losing theirs. Part 3. Chapter 10. Conservative versus Conventional. A public opinion poll is no substitute for thought. January 18, 1965. Following the crowd can be a remarkably effective strategy in most situations. When you're at an unfamiliar school to watch the big game, following the mob before kickoff is usually a good way to find the stadium. Similarly, if you see people running panicked out of a movie theater, it's a pretty good sign you shouldn't go in. The next time you see a gathering of people all looking intently in the same direction, see if you can keep yourself from looking too. I'll bet you can't. This instinct, which is programmed into our human condition, is called social proof, and it tends to be very helpful in most situations. Social proof also happens to be the muse of the investing underworld. It lures you in with the comfort that comes with being part of the crowd, and then kills your chances for outperformance because, by definition, being part of the herd means your investment views will lack sufficient variance. It is very hard for the majority to do better than average. Successful investing requires you to do your own thinking and train yourself to be comfortable going against the crowd. You could say that good results come primarily from a properly calibrated balance of hubris and humility. Hubris enough to think you can have insights that are superior to the collective wisdom of the market, humility enough to know the limits of your abilities, and to be willing to change course when errors are recognized. You'll have to evaluate facts and circumstances, apply logic and reason to form a hypothesis, and then act when the facts line up, irrespective of whether the crowd agrees or disagrees with your conclusions. Investing well goes against the grain of social proof. It goes against the instincts that have been genetically programmed into our human nature. That's part of what makes it so hard. Howard Marks, a Buffett contemporary who also has a literary bent, challenges his readers to dare to be great in order to dare to be better investors. As he tells his readers, "The real question is whether you dare to do the things that are necessary in order to be great. Are you willing to be different, and are you willing to be wrong? In order to have a chance at great results, you have to be open to being both." Throughout his career, Buffett has found success by daring to be different and rarely being wrong. The letters provide insight about the two key ideas behind his staunchly independent approach. First, conservatism in investing is based on correct facts and sound reasoning alone. While it can be conventional, it's often unorthodox. An investment has to make sense to you. The crowd's preferences should not sway your own. In fact, the last one to join the crowd is likely to be the one paying the highest price. The best purchases are made at the very opposite moment in time, when your thinking puts you in opposition to the conventional wisdom or sweeping trends. Second, a concentrated portfolio can actually be more conservative than a diversified one when the right conditions are met. Conventional academic thinking often is at odds with this idea. It's lured away from the better less is more conclusion by elegant math that gets it wrong because it's based on a faulty premise. The idea that the beta of a stock, how much it wiggles around, is an appropriate measure of its riskiness, the chance of a permanent loss. This faulty linkage is then extrapolated to mean that a lower beta portfolio is the less risky one. Because mathematically, the addition of another stock does lower a portfolio's overall beta, incremental diversification is seen as incrementally lowering overall riskiness. If A equals B and B equals C, then A equals C, right? The idea that beta equals risk has caused, and continues to cause, a lot of fuzzy investment thinking. Munger and Buffett would tell you it's such a common mistake because the math is so elegant. Practitioners using the tools of engineering and calculus have the ability to come to erroneous conclusions that carry several figures to the right of a decimal point. Such precision leads to a false sense of security. Better to be roughly right than precisely wrong, as Keynes liked to say. Buffett concentrated heavily and felt his actions were highly conservative. Why buy your 10th best idea, not to mention your 100th best idea, when you can still buy more of your favorite at attractive prices? There is a lot to learn from Buffett on managing risk and the opportunity costs of the marginal investment dollar in his commentary on the true meaning of conservatism. Thinking for yourself. To Buffett, if it's rational, it's conservative, period. Sometimes this approach ends up being conventional, and sometimes it doesn't. As he said, "You will be right over the course of many transactions if your hypotheses are correct, your facts are correct, and your reasoning is correct. True conservatism is only possible through knowledge and reason." In investing, the herd typically gets it wrong. The best time to be a buyer of securities is when the mob is most fearful. Even when the taxi drivers are talking about their stock portfolios, it's prudent to be cautious. There's an old saying on Wall Street, what is a good idea in the beginning is often a bad idea in the end. Buffett claimed no comfort when large numbers of people agreed with him. He didn't care what those in positions of influence and authority thought. He recognized that conventionally, something met the test of conservatism when a lot of people were in agreement, including the experts. He makes a strong point to distinguish his view of what makes something conservative from the conventional view. The partnership lessons teach investors that there is only one set of circumstances where you or anyone else should make an investment: when the important facts in a situation are fully understood and when the course of action is as plain as day. Otherwise, pass. For instance, in Sanborn, when Buffett realized he was virtually assured to make money in the stock given he was buying the securities portfolio at 70 cents on the dollar, with the map company coming for free, he invested heavily. When he saw Dempster was selling below the value of its excess inventory alone, he loaded up. In each case, when he was within his circle of competence, and he understood the factors dominating the likely outcomes, he took action. When we really sit back with a smile on our face is when we run into a situation we can understand, where the facts are ascertainable and clear and the course of action obvious. In that case, whether other conventional or unconventional, whether others agree or disagree, we feel we are progressing in a conservative manner. Loading up. As Buffett told partners, of course, it would be ideal if he could find 50 different opportunities with equally strong probabilities of a 15% gains versus the Dow. That way, even if he turned out to be wrong on a couple, results would still be incredible. But as he said, it doesn't work that way. We have to work extremely hard to find just a very few attractive investment situations. The benefits of incremental diversification largely run their course after the first 6 to 8 uncorrelated businesses, stocks, are added to a portfolio. Here we're talking about diversifying the drivers of each individual company's profits, not the covariance of their stock prices or anything technical like that. You can neutralize a lot of unintended bets with just a few ideas. For example, if you own ExxonMobil, integrated oil company, and Sherwin-Williams, architectural coatings company, you'll be rather indifferent to the direction of the price of oil. Rising prices are generally good for Exxon's profits, but bad for Sherwin's, because oil and oil-based derivatives comprise the lion's share of Exxon's revenues, but also the lion's share of Sherwin's manufacturing costs. Presumably, you've invested in these two businesses for a reason aside from your view on where oil is going. No idea. And so it's better to have it neutralized as a factor potentially affecting your portfolio, all else being equal. If you can find 6 to 8 diverse ideas, you can neutralize the bulk of these unintended consequences. However, after this first handful, adding additional stocks reduces risk by an ever-decreasing amount. The benefits quickly become outweighed by the reduction to the portfolio's expected return. The fact of the matter is that good ideas, low-risk, high-return potential investment opportunities, just don't come around that often. Most times the expected return from number 7 will be far below your number 1 idea. Buffett grew increasingly convinced of the benefits of loading up when the conditions were right. In 1965, he amended the ground rules to include a provision that allowed up to 40% of BPL's net worth to be in a single security under conditions coupling an extremely high probability that our facts and reasoning are correct with a very low probability that anything could drastically change the underlying value of the investment. In other words, when the facts are ascertainable and clear, the course of action obvious, and the chance of loss minimal, you load up. He gave a group of students the following advice in the late 1990s. If you can identify 6 wonderful businesses, that is all the diversification you need, and you will make a lot of money. And I can guarantee that going into a 7th one instead of putting more money into your first one is got to be a terrible mistake. Very few people have gotten rich on their 7th best idea. but a lot of people have gotten rich with their best idea. So I would say for anyone working with normal capital who really knows the businesses they have gone into, 6 is plenty, and I would probably have half of it in what I like best. There are still plenty of active managers running 100-plus stock portfolios, just as there were in the partnership era. Buffett comments derisively about this group in the letters. Anyone owning such numbers of securities after presumably studying their investment merit, and I don't care how prestigious their labels, is following what I call the Noah school of investing, 2 of everything. Such investors should be piloting arcs. While Noah may have been acting in accord with certain time-tested biological principles, the investors have left the track regarding mathematical principles. I only made it through plane geometry, but with one exception, I have carefully screened out the mathematicians from our partnership. Testing conservatism. Buffett was quick to acknowledge that his ideas were highly subjective and offered a quantifiable way to approach the question. One rational way to evaluate the conservativeness of past policies is to study performance in declining markets. He then set out his evidence, showing how BPL consistently did better in down years. This remains a good exercise to test the past conservatism of any investor. From BPL's start through 1965, the Dow had 3 down years. When those 3 years were combined, the cumulative performance of the partnership was plus 45%, while the Dow was minus 20%, and the other managers he regularly compared himself to were down between minus 9% and minus 24% on like-for-like basis. While he admitted that the comparison was not all important, he did say, "Evaluation of the conservatism of any investment program or management, including self-management, should be based upon rational objective standards, and I suggest performance in declining markets to be at least one meaningful test." The fact that Buffett never had a down year during the partnership era is truly remarkable. Stanley Druckenmiller, who had previously made billions with George Soros, never had a down year at his hedge fund, Duquesne, where he managed money for 20 years. Joel Greenblatt, another famous investor who averaged 50% returns per year at Gotham, never had a down year in the 10 years from 1985 to 1994. The ability to perform well in down markets is a hallmark shared by all 3 of these great investors. Your best idea defines your next choice. When considering the merits of adding a new idea to the investments you already have, compare it to the best of what you already have. Understanding your ideas in this framework will keep you from owning too many stocks and diluting your expected returns. If you have never heard of the equity cost of capital or the capital asset pricing model, you are much better off. These are somewhat complicated tools created by the mathematically oriented crowd to answer what is otherwise a pretty simple question. Given the investment choices available any given time, what is the minimum expected return needed from a new idea to make it a worthy addition to your portfolio? Those who derive this number with a calculator or a spreadsheet are again mistakenly commingling beta and risk, and often producing mathematically elegant but not very helpful tools. Forget all that stuff. When a new idea comes along, only buy it when it's more attractive than buying more of what you already own. Buffett's version of true conservatism stands in stark contrast to conventional definitions. At its root, his version is based on the power of thinking for yourself and applying sound reason. Facts determine an action's conservatism, not popularity. This allows him to go against the crowd and concentrate heavily in his best ideas. Lessons from the Partnership Letters: Conventional versus Conservative. January 24, 1962. The question of conservatism. The description of our various areas of operation may provide some clues as to how conservatively our portfolio is invested. Many people some years back thought they were behaving in the most conservative manner by purchasing medium or long-term municipal or government bonds. This policy has produced substantial market depreciation in many cases, and most certainly has failed to maintain or increase real buying power. Conscious, perhaps overly conscious, of inflation, many people now feel that they are behaving in a conservative manner by buying blue-chip securities, almost regardless of price-earnings ratios, dividend yields, etc. Without the benefit of hindsight, as in the bond example, I feel this course of action is fraught with danger. There is nothing at all conservative, in my opinion, about speculating as to just how high a multiplier a greedy and capricious public will put on earnings. You will not be right simply because a large number of people momentarily agree with you. You will not be right simply because important people agree with you. In many quarters, the simultaneous occurrence of the two above factors is enough to make a course of action meet the test of conservatism. You will be right over the course of many transactions if your hypotheses are correct, your facts are correct, and your reasoning is correct. True conservatism is only possible through knowledge and reason. I might add that in no way does the fact that our portfolio is not conventional prove that we are more conservative or less conservative than standard methods of investing. This can only be determined by examining the methods or examining the results. I feel the most objective test as to just how conservative our manner of investing is arises through evaluation of performance in down markets. Preferably, these should involve a substantial decline in the Dow. Our performance in the rather mild declines of 1957 and 1960 would confirm my hypothesis that we invest in an extremely conservative manner. I would welcome any partners suggesting objective tests as to conservatism to see how we stack up. We have never suffered a realized loss of more than 0.5% of 1% of total net assets, and our ratio of total dollars of realized gains to total realized losses is something like 100 to 1. Of course, this reflects the fact that on balance we have been operating in an up market. However, there have been many opportunities for loss transactions even in markets such as these. You may have found out about a few of these yourselves, so I think the above facts have some significance. January 18, 1965. The question of conservatism. In looking at investment company performance, the question might be asked, yes, but aren't those companies run more conservatively than the partnership? If you ask that question of the investment company managements, they, in absolute honesty, would say they were more conservative. If you ask the first 100 security analysts you met, I am sure that a very large majority of them also would answer for the investment companies. I would disagree. I have over 90% of my net worth in BPL, and most of my family have percentages in that area, but of course that only demonstrates the sincerity of my view, not the validity of it. It is unquestionably true that the investment companies have their money more conventionally invested than we do. To many people, conventionality is indistinguishable from conservatism. In my view, this represents erroneous thinking. Neither a conventional nor an unconventional approach per se is conservative. Truly conservative actions arise from intelligent hypotheses, correct facts, and sound reasoning. These qualities may lead to conventional acts, but there have been many times when they have led to unorthodoxy. In some corner of the world, they are probably still holding regular meetings of the Flat Earth Society. We derive no comfort because important people, vocal people, or great numbers of people agree with us. Nor do we derive comfort if they don't. A public opinion poll is no substitute for thought. When we really sit back with a smile on our face is when we run into a situation we can understand, where the facts are ascertainable and clear, and the course of action obvious. In that case, whether conventional or unconventional, whether others agree or disagree, we feel we are progressing in a conservative manner. The above may seem highly subjective. It is. You should prefer an objective approach to the question. I do. My suggestion as to one rational way to evaluate the conservativeness of past policies is to study performance in declining markets. We have only 3 years of declining markets in our table, and unfortunately, for purposes of this test only, they were all moderate declines. In all 3 of these years, we achieved appreciably better investment results than any of the more conventional portfolios. Specifically, if those 3 years had occurred in sequence, the cumulative results would have been Tricontinental Corp. minus 9.7%, Dow minus 20.6%, Massachusetts Investors Trust minus 20.9%, Lehman Corp. minus 22.3%, Investors Stock Fund minus 24.6%, Limited Partners 45%. We don't think this comparison is all important, but we do think it has some relevance. We certainly think it makes more sense than saying, we own, regardless of price, AT&T, General Electric, IBM, and General Motors and are therefore conservative. In any event, evaluation of the conservatism of any investment program or management, including self-management, should be based upon rational objective standards, and I suggest performance in declining markets to be at least one meaningful test. January 20th, 1966. Diversification. Last year, in commenting on the inability of the overwhelming majority of investment managers to achieve performance superior to that of pure chance, I ascribed it primarily to the product of 1. Group decisions. My perhaps jaundiced view is that it is close to impossible for outstanding investment management to come from a group of any size, with all parties really participating in decisions. 2. A desire to conform to the policies and, to an extent, the portfolios of other large, well-regarded organizations. 3.